Ladies and gentlemen, how are you? I hope you are fine wherever you are. I am the ACCA tutor, Mr. Jeremy Timkulu, and in this particular video, we are going to delve a step further from our management accounting standard costing experience into something a little bit wild but not terrifying. Okay, so we are going to be systematic in everything we are going to do, because by the end of the day you just need to be organized for you to pass this paper. Actually, you must congratulate yourself for reaching week 6 with us. Sometimes it's very difficult, the assignments, the workload. Sometimes we are not merciful, but we'll be trying to ensure that we cover as much ground as possible and you get value for money. Okay, so do not be scared by the term advanced variances. They are still those original or basic variances, but with some flavor to ensure that this time you are at managerial level. It's no longer knowledge level, but managerial. Remember, after this paper, you will be, if you choose to, you would be eligible for the APM exam, Advanced Performance Management, to ensure that you are actually somebody who is certified in management accounting. Okay, so it's a good paper. Actually, it's very, very good for an accountant or a finance manager, right? The APM paper is designed for those at the, those charged with governance, those people at the top of the company, the finance directors and so forth. But anyway, this paper is going to prepare you for such career path or avenues. All right, so without much ado, let me just take you to the objectives of the lecture. By the end of this lecture, you need to be able to explain the fundamental uses of standard costs in performance management. All right, this part of our syllabus, ladies and gentlemen. We should also be able to outline how standard costs are derived and understand different cost types. This is our work. Articulate the critical role of flexed budgets in accurate performance evaluation. Of course, I know we have done flexed budgets at management accounting level, all right? So we just need to spruce up such that we understand what really or how these budgets matter most. All right. Remember, things always change. Even the financial world is dynamic. So we need to ensure that our performance management or measurements are relevant to what is obtaining on the ground. So that's the purpose of flexed budgets. They are changed in line with what is actually happening. Okay, so we need to tailor-made our budget to ensure that it suits what we can achieve or what is happening in the external world. Then we need to apply principle of controllability in performance management systems. So the aspect of controllability matters, because by the end of the day, we cannot punish somebody on things they cannot control. You should be able to calculate, interpret, and explain material mix. This one is troublesome. And its counterpart, yield variance, material yield variance. Discuss the broader implications of changing material mixes. What are the implications when we change material mix or material combinations? Understand the relationship between material usage, mix, and yield variances. Suggest alternative methods for controlling production processes. There are other methods outside standard costing which could be used by an entity to ensure that it is controlling its production processes. So you can see that we are just taking a step further from what we were accustomed to within the ACCA paper management accounting environment. You should be able to calculate, interpret, and explain sales mix and quantity variances. So we are not going to only stop at material variances, but we are also interested in the sales side part of the equation. Understand the relationship between sales volume mix and quantity variances. This is an example, ladies and gentlemen. Examiners always love these sales volume mix and quantity variances. They love them. So you should be able, by now, actually by the end of the lecture, you should be able to understand the relationship between these variances. Calculate revised budgets and identify appropriate revision factors. You must be able to tell the examiner when a revision of a budget is necessary. In what situation should that happen? And you should be able to come up with a revised budget. So you'll be able to do that by the end of this lecture. Calculate, interpret, and explain planning and operational variances for sales, materials, and labor, including the learning curve effect. We have done learning curves and the theoretical underpinnings of learning curves and their computations is not part of the remit of this lecture because we have already covered those things, isn't it, guys? Yes, I'm sure if you have been studying with us, you are aware that the learning curves have been done inside out, left, right, rear, and center. Okay? So we have done everything about learning curves, but now we just have to relate them to variances. That concept, we need to then fuse it with labor variances. In most cases, that would be usually a discursive part of the question where you need to actually use that knowledge from learning curves and then you speak something in relation to a labor rate variance. Okay, all those things. Then last but not least, discuss the potential for manipulation when revising budgets. Sometimes, managers tend to manipulate figures to ensure that they suit what they desire as an outcome. So there should be some ethical considerations in coming up with budget figures. We need to be ethical. In as much as we are ethical in financial reporting, even at costing level, we also need to be very, very ethical. All right. So remember, this is a professional examination. So ethics are at the core of every part of an ACCA module. Okay. Let's move on. Why standard costs? Okay. Think of it as a target. The standard cost is actually a target. Technically, standard costs are preset targets for costs and revenues under efficient operating conditions. So when you hear of standard cost, don't always think of cost, but also think of the revenue side. This is why we also include sales variances, the sales volume, the sales mix, sales price, all those things they are the revenue side of standard costing. Are we together, ladies and gentlemen? So I don't expect you guys to always think of just costing as an issue of, the expenditure side part of accounting. No, we are also interested in the revenue side. So what are the key uses of standard costs? Number one, performance evaluation. We need to ask ourselves, how did we do compared to what we should have done? So what have we done currently in relation to what we should have done? Okay, so how did we do compared to what we should have done? That's performance evaluation. Then variance analysis. This relates to the aspect of spotting the differences and figuring out why. So first of all, you need to actually determine the difference and then tell us why does the difference exist. Then budgeting. We have been talking of flexed budgets. We need to build budgets which adapt to actual activity, not out of this world budgets, but budgets which speak of the actual things happening on the ground. Standard costs are also essential for control purposes. We need to be proactively managing costs. Remember, when we were introduced to, management accounting, there was an aspect of business organizations where we were told that an organization should be something that has got, something that can control its own performance. If you cannot control your performance, but other people are doing so, then it means you are not an organization. All right? So, organization theory can actually, be drilled down to a section or a department. If it is a department and you are the one in charge, you should be able to be proactive in managing the cost. So you should be proactively managing those costs which relate to your department. When I say costs, remember, I'm not only talking of the expenditure side, but also the revenue side. All right, so you should be able to be, to proactively manage those costs. So standard costing gives you that edge, that power, that exposure, that skill to be able to control your environment, your business environment. Then, inventory valuation and pricing. Standard costs provide a baseline in determining the appropriate inventory valuation metric, or let me just say base. Okay, so they give us that idea. All right. Remember, this is also in line with the IAS 2 inventories when it comes to financial accounting. All right, IAS 2. All right, where we use the fee for standard cost, etc., the average, with the weighted average cost methods and so forth. Those are the valuation techniques for inventories. All right, then lastly, we need to be able to motivate our employees, our people. So if we know the targeted cost, we are in a better position to strive, knowing that we are aiming for a common goal. All right, but this goal should be achievable. So when setting standards, when we are setting standards which are achievable but not easy, by the end of the day, we will be motivating people to reach the goal, okay, to feel the need to do the task. So We need to give them clear and achievable goals so that in the end breeds motivation. Okay? Uh, Remember, part of our objective was to be able to explain how targets are derived at. Okay, so there are various derivation methods or techniques which are used to arrive at standard cost. All right, that's a different question from or a different aspect from the types of standards. All right, the examiner might want you to tell him how are targets arrived at, or how are standard costs arrived at. In that situation, you should be able to tell him the derivation methods. Okay? We are not talking of derivatives. We are talking of methods of arriving at targets. The avenues taken to reach targets or to create or to originate targets. So there are about 4 ways in which targets are derived at. The first one, sometimes we use historical data. That is, we look back. We use this with caution because, we might end up inheriting past inefficiencies in creating our budgets or in setting targets. Sometimes people just want to use shortcuts, so they tend to recommend those paths as industrial standards or as industrial standard when in actual fact it shouldn't be. So when we use historical data, we must be careful, we must be cautious that we are not inheriting past inefficiencies. So we use this one with caution. Then sometimes we use what are called technical estimates, or we just engineer it. Time and motion studies, material specifications, the most rigorous. So in this way, we'll be trying to at least use some engineers to tell us the most, appropriate way of arriving at a standard. We use some rigorous processes. Sometimes we have to hire experts in the field to ensure that we arrive at the best possible standard that can be there in that area. You can't use an accountant alone to value, to arrive at a cost per kilogram of asbestos. You need somebody who has done at least quantity saving or similar, qualifications for us to get an idea that is reasonable or that is beyond any reasonable doubt, or that is able to convince any reasonable person that it is actually a fair cost. All right, so in that case, we are engineering the standard. Sometimes we compare things. What do others do? And what are we doing? Then we arrive at a benchmark. So benchmarking is sometimes used to arrive at a target. You see, when we set our cost too much higher than what competitors are doing, by the end of the day, when we then set a selling price, we'll discover that nobody is going to buy our things. So we need to strive to ensure that our costs are competitive enough to ensure that we remain in business by the end of the day. So we need to drive to arrive at that cost competitors are also achieving. Right? So we need to ask ourselves, what are the best in the business doing? What are they doing? Because you're not living in an island. There are competitors out there. They are very cruel. They are not going to have mess on your business. So you need to set that standard that is able to withstand the competition. Last but not least, negotiation. We need to negotiate to arrive at that standard. So we need to get buy-in from different departments. You need to do some little bit of consultation among departments, various relevant departments to arrive at a target. Otherwise, if the target is not going to be bought by other supporting functions, by the end of the day, there is going to be some sabotage. So you need to negotiate. So these are some of the methods you might use to arrive at a target. Now let's talk of a typical subject area, the types of standards. This one, obviously, we did it in our MA studies. If you were exempted, I'm sorry. Okay, if you didn't get the touch of management accounting, it's fine. This is the chance for you to get to the grips with the area. Now, types of standards. The first type is the ideal standard. Okay, now the list has not been made in the chronological sense of what we have been accustomed to. Usually we start with the basic and so forth, but doesn't matter. What you need to know is what we mean by saying ideal standard, attainable, basic, current, all those things. Okay, the ideal standard is the standard that is set for the perfect world. A world where there are no accidents, a world where there are no delays or need for supply chain management or client relationship management. It's not needed, it's not necessary, because the world is actually an efficient world. All right? Do we have that world? That world exists? That's the question you need to ask yourself. So ideal standards are very rare. Okay, they are rarely achievable. Why? Because we do not have such a world. Okay, even in those countries where there is good life, good business environment, and so forth, there are also some glitches here and there. They are not perfectly perfect world or efficient world. All right, but as a business, we need to have that aspiration. Okay, we need to have that aspiration. So we need to inculcate that idea in the minds of our workforce. All right, so that's a long-term aspiration. So in your discussions, in as much as you point out that the standard, the ideal standard is for a perfect world and rarely achievable, you then have to point out as a parting shot that but an entity should aspire to have such standards in its long-term plans, such that by the end of the day, we make the earth a better place to live in. Isn't it? Good. Now, attainable standards. Attainable standards are realistic. They are efficient, but they also allow the realities of this world. They allow normal hiccups. They are the most common for performance. Okay, they are the most common for performance. Actually, these ones are common standards, which are, they are set to ensure that the operations are as efficient as possible, but they realize that normal losses are also there, here and there. They are basic standards. All right, basic standards. These ones are long-term trends, less useful for immediate control. All right, so they lack some motivation. They are basic. Actually, they are minimum standards, right? They are minimum. We expect an entity to achieve this, all right? But they do not motivate people, all right? They have been there, historically there, and maybe when the company was formed, those with the, the standards which were known to exist, and the industry has bought them. They're actually known for, they've been set as industrial standards, all right, maybe by custom, etc. But they are not going to set us apart. But it will be very deplorable if you fail to meet the basic standard. You see where we are going? So as a minimum, a company should be able to meet those, right? They are expected by anybody in business to meet, all right? But they are not going to enable us to be competitive, all right? So they are like historical in nature. They are basic as their name entails, but they are not going to motivate people to be innovative, to be excellent, and so forth. All right? That's the idea behind the basics. Then, current standards. The current standards are actually based on today's conditions. They are good for short-term decisions. Okay? Sometimes when we see that this is we are entering an Easter holiday, or we are in an Easter holiday, and consumers, they want Easter eggs. We set a target to say that, guys, on this first Friday of the Easter, on the Friday, on the Easter Friday, actually, on the Easter Friday, we need to ensure that we sell 1,000 eggs. All right. So that's a short term. All right, that's just for the current period. All right, that's for short-term decision making. It's a standard for short-term decision making. All right, so or maybe there's going to be some, or maybe we have received the need for certain products to be in the market because of a certain ensuing environmental condition, like for example, during the COVID era, the sale of face masks, all right, face masks. So targets linked to the sale of face masks or sanitization, those chemicals, those targets were actually short-term targets. Why? Because we did not expect the COVID to be there forever. Okay, but we set those targets just for those periods alone. All right, so they are based on what is prevailing currently. All right, or maybe we are expecting a new monetary policy coming next month. There is going to be a reduction of taxes, or there's going to be an increase in taxes. So we set our targets in line with such an anticipation. But that one is a short-term target. Something relating to what is currently happening in the market. Are we together, ladies and gentlemen? Those are the examples which I think could be essential to you. Now let's come back to what are called flexed budgets. All right, remember these ones, I said that they enable us to compare apples to apples. All right. Reflect budgets is that we must not compare apples to oranges, but apples to apples, oranges to oranges. Okay, but before we go to flex budgets, we used to have what are called static budgets. They were set at the start of the period, and they were made to run until the period ends. And then that's when we then compared um, the performance with against the budgets, the actual performance against the budget. All right. This tend to mislead, okay, because sometimes the outputs were actually different. The actual outputs were actually different from, they were far different from the budgeted output. All right. But you also have to remember that with the use of standard costs, there is some proactive control. We need to be proactive. We must always alert throughout the year. We must be alert. We shouldn't have to wait until the year end to, reorganize ourselves. All right. And we also have to be able to compare our performance at certain levels of activity, not only one level of activity. All right. So flexed budgets show cost or revenue. Please always remember cost and revenue. That's the aspect of standard costing. All right. We are looking at both costs and revenue. So flexed budgets show costs or revenues at different actual activity levels. We flex the budget to actual output. All right. Why does that matter? There is actually fairer comparisons that is going to be achieved or sustained. What should our costs have been for the actual output? That's the question we ask ourselves. There is going to be better variance analysis or variance insights, as we will be separating volume effects from cost control issues. There is going to be informed decisions, as relevant cost information for varying production is going to be availed or used. Accountability. We will be able to hold managers accountable for controllable costs at their actual operating level. Okay, so with the use of flexed budgets, we are drawing the powers. We are reducing the powers of external factors and bringing the situation to what the manager can control. Right? So we will be able to then judge the manager's performance on a flexed budget, on something that is under his control. Let's talk more of the power of control. We need to ask ourselves, who is responsible for this particular action or cost? We are taking the principle of controllability further. The rule: managers should only be judged on what they can influence. In practice, we have learned of responsibility centers, where individuals or departments are organized by the level of control. Is this a cost center, a revenue center, a profit center, and investment center. All right. Then targeted reporting. This shows the costs which were controllable, the variances which were controllable versus those which were uncontrollable. There is fairer evaluation in the sense that we are focusing on what's within a manager's remit. What is this thing under the manager's control? So we are focusing on what is under the manager's control. Then, motivation boost. There is going to be high ownership and proactive management. So, the essence of flexed budget. When a question talks of you commenting on the performance of an organization, this is the theoretical underpinning you should factor in when answering that part of the question. The aspects of control, right? What control brings. There is an aspect of high organization of the process itself. We need to organize ourselves by the level of control. Are we a cost center, a revenue center, profit center, or investment center? Then we should also be able to speak of controllable versus uncontrollable costs. We need also to talk of what was the issue. Was it under the manager's control or influence or something else? And then there is also an aspect of ownership and proactive management when we are focusing on those things which the manager can control. There is ownership. The manager feels motivated to work. Why? Because they are judged on things they can control. You can't judge them on things they can't control. For example, you can't blame the production manager on the prices of raw materials if the raw material price variance is adverse. If this variance is adverse, can you blame the production manager on price issues? He doesn't have control on raw material prices. The person who should be blamed there is actually the purchasing manager, right? Because he would have failed to negotiate, or you would have failed to expose the company on those order quantities which entitle the company to discounts, bulk discounts. Or he could have failed to capitalize on promotions, supplier promotions, and then when he lodged his orders, the promotion would have ended. So all those things are aspects which should be blamed on the purchasing manager, not directly to the production manager. He doesn't have control on prices of raw materials. Are we together, ladies and gentlemen? So that's the idea of the power of control. Here is a recap to those who were exempted to the paper management accounting. This was a very essential paper, but a lot of you guys are doing this examination and have been exempted from writing this essential paper. It was actually a costing paper, real costing, right? Where all the foundations have been spoken. So let me just give you a recap of these variances. Remember, we are going to do a question by the end of this lecture. There is going to be a solved exam type question. I'm going to solve an exam type question with a lot of variances for you, just for you guys. So just hang on till the end of the video. Is that clear, ladies and gentlemen? Good. So recap. The first variance we are going to look at is the material price variance. Okay, material price variance. This one is given by the standard cost. Okay, standard cost, sometimes in other textbooks, they just say, because we are talking of material price, so they use standard price minus actual price multiplied by the actual quantities which were procured. Okay, so cost and price, right? Sometimes we use cost, sometimes we use price. So that's the standard cost minus actual cost, or standard price minus actual price multiplied by the actual quantity. Is that clear, ladies and gentlemen? Good. This is just a recap. Okay, if you want the theoretical underpinnings or all those things relating to this particular variance, please refer to the MA content. All right, and then the material usage variance. Material usage variance. This one is given by the standard quantity minus actual quantity multiplied by the standard cost or standard price. Remember, these are prices or costs set by the manufacturer or maybe the supplier, by the supplier. Okay? Then there is the labor rate variance. Labor rate variance. All right. One thing I want you to appreciate is that these are called total variances. All these basic variances are called total variances. So the purpose of this module usually is to dissect these total variances into their nitty-gritties to understand what will be going on, because these are totals, so they need to be dissected. We need to disorient them, to analyze them deeper. Is that clear, ladies and gentlemen? Good. So the labor rate variance is given by the standard rate minus the actual rate multiplied by the actual hours. We are talking of hours worked. This is labor hours, remember. So labor rate variance, standard rate minus actual rate multiplied by the actual hours worked. What about the labor efficiency variance? This one now talks of the standard hours minus the actual hours multiplied by the standard rate. Is that clear? Am I talking to somebody? Am I saving a soul? If I'm doing so, then may you guys say amen. Then there is an aspect of overhead variances. These ones, I want you guys to read about them. Okay? They are really tested. They're actually not going to be tested in this paper, but you need to, when it comes to the discussion of overheads, you need to know them. You need to know these variances is part of the theoretical things you need to write. Examiners like students who show the aptitude and positive attitude in exhibiting their intellectual capabilities or talents. Then there is the this SPV is actually the sales price variance. Sales price variance. Are we together? The sales price variance. So we are looking at the standard selling price. Okay? The standard selling price or the standard price, okay? The standard price, the budgeted price or the budgeted selling price minus the actual selling price. The actual selling price or the actual price multiplied by the actual quantities which were sold. Then last but not least, the elephant in the room, the notorious one. This one is notorious, ladies and gentlemen, I tell you. All right, but it's not notorious, but it's very common. It's a rich pool for examination, this one, for examination questions. So, the sales volume variance, it's a total variance again, and this one, talks of the budgeted quantity minus the actual quantity sold multiplied by the standard contribution or standard profit. Okay, contribution if we are talking of marginal costing, and standard profit when we are talking of absorption costing. So it depends on what the examiner says about the operating systems or operating environment or their costing environment of the entity. Which methods do they use in costing their inventories? Are they adopting the marginal costing or the absorption costing technique? So all those things should be then considered for you to determine how you are going to compute your sales volume variance. So standard contribution or standard profit are the only two choices you need to make in relation to what the question is saying. All right, you must also use the information provided in the scenario. Sometimes the examiner talks of the standard contribution, then automatically you need to use the standard contribution, and you need to tell yourself that they are using a marginal costing. Or if the examiner says that they use marginal costing in the valuation of their inventories, in their production processes and so forth, so obviously you'll be using standard contribution. But if the examiner says that they are using absorption costing, remember absorption costing is also called total costing. So in those situations, then when you're calculating your your SVV, your sales volume variance, you need then to factor in the multiplication by standard profit. Everything will remain the same in the bracket here, but the difference comes on either standard contribution or standard profit. Okay, so that was a recap of the total variances or basic variances. Is that clear, ladies and gentlemen? So let us move on. Let's talk of this animal called material mix and yield variance. All right. Which one material? When one material isn't enough, we need then to analyze blended materials. Remember, when we were doing these basic variances, we were looking largely on a single material. All right, but this time we are going to be tested in a situation where more than one material is going to be given to us in a question. So or will be exposed to production processes where an item of product is going to use more than one material. So in that case, you need to be then able to compute the material mix as well as the yield variances. So these are applicable when we are using multiple interchangeable materials. Total material usage variance, the overall difference, this is the overall difference of the actual quantity versus standard quantity at standard price. So we have shortened it here to material usage variance is equal to actual quantity minus standard quantity multiplied by standard price, and as I have indicated, this is part of the basic variances. Okay, that's the basic variance. But remember, it is a total variance that is explained by these two material mix and material yield variances. All right. So if we add the material mix and the material yield variances, we are going to get the material usage variance. This is why I say that the material usage variance is a total variance. All right. So how do we compute the material mix variance now? This variance shows the cost impact of using different proportion of materials than standard for the actual total input. Thus, material mix variance is equal to actual total quantity at standard mix minus actual total quantity at actual mix multiplied by the standard price. In short, that's actual quantity at standard mix minus the actual quantity. All right? So remember, when we are saying actual quantity at standard mix, we are actually flexing. All right? We are flexing the actual to reality. Okay? We are flexing the actual, we are flexing the budget, the original budget to reality. Right? So standard mix is actually the budgeted mix. All right? Or the budgeted ratio. But we are taking that budget to the actual quantities so that we'll be able to gauge if the manager was doing it right, if the production manager was doing it right, given the actual circumstances. Is that clear? If the variance is favorable, then it shows that the materials were more cheaper, okay, or less expensive. That's what it tells us, the material mix variance. All right. Now, what about the yield, the material yield variance? This one shows the cost impact of getting more or less output than expected from the actual total input. Thus, material yield variance is equal to standard cost of actual output minus standard cost of expected output from actual input multiplied by the standard price. All right. Why are we always multiplying by the standard price in both of these? Because even their mother, the total variance, the MUV is also multiplied by the standard price. All right. So these other segmented formulas should as well follow the same pattern. So the material yield variance, in short, is given by the actual quantities in standard mix minus the standard quantity multiplied by the standard price. Is that clear, ladies and gentlemen? Good. So if this yield variance is favorable, it means that we have produced more from the little resources. It shows something to do with efficiency. Okay, the yield variance talks of the efficiency of the production process. Is that clear? Thank you. So here's an example, ladies and gentlemen, a numerical example. All right. Material mix and yield variances. Okay, so the standard mix for 100 units of product X is as follows. There is material A, material B. Material A requires 60 kgs at $2 per kg. Material B, 40 kgs at $3 per kg. What is the standard input? The standard input is 100 kgs. Okay, so 100 kgs of inputs can produce 100 units. So in this case, we are having a 1:1 ratio. Okay, it's essential to know that. Okay, 100 kgs of inputs are going to produce 100 units. This one is actually that setting this particular standard is actually the ideal situation, all right, where 100 kgs exactly are going to produce 100 units of output. The 100 kgs of raw materials are going to produce 100 units of output. That's an ideal situation, isn't it? Where there are no production errors, no more losses, or all those things. Everything is going to be 100% efficient, 100% super. That's something that is not real in this world. Now, the information given about the actual production is as follows. Actual production product X, 200 units. Actual materials used. So we have got the actual production was 200 units, okay? And the actual materials used are material A, we used 130 kgs, and material B, 80 kgs. All right? Required. We need to calculate the material mix and yield variance. All right. So if the standard, this was the standard, isn't it? The standard was that 1 kg was going to yield 1 unit. All right. 1 kg of raw material was to yield 1 unit of production. But in this case, look at what happened. We used 200 kgs, 210 the total actual input, remember, this is the input, 200 kgs led to 200 units. So something went wrong somewhere. Are you seeing it? It's against our ratio. Okay, the original ratio has been violated, isn't it? This time we've used more units than expected. Just from analyzing, you can actually see that something went wrong. So let us then do the material mix and yield variances. So we'll be doing back and forth to ensure that we understand what is going on. Okay. Now, first of all, we know that the material usage variance, which is the parent variance or the total variance of these two, is given by actual quantity minus standard quantity multiplied by that one. Okay, it's essential to know that, because you know when you want to gauge if you have done things right, you can as well you know, especially if a question asks you to compute both the material mix and the yield variance, then you can check yourself to see if your calculations have been correct or not. Why? Because if you add the material mix and the yield variance, you should come to the material usage variance. This is why we did the usage variance there. All right. So the standard quantity for actual output, the 200 units. We know, as have been given, material A, 60 kgs, all right? The 60 kgs could, we needed here, the 60 kgs were needed to produce 100 units, all right? So if we are now talking of the 200 units which were actually produced. Remember, we actually produced 200 units. So we want to flex the budget to the actual production. The actual production was 200 units. All right, but our ratio in terms of the ingredients, the ratio was that 100 units required 60 kgs. Okay, so what about 200 units? So 200 units should be 200 over 100 multiplied by, it should be, we are saying 60, all right, 60 kgs, 200. 6 kgs produced 100 units. All right. What about now 200 units? All right. So the 200 units should actually be, so I was right. So if we cancel this, we are going to see that the 200 units will require 120. That's 2 multiplied by 60, which is 120 kgs. That's fine. It's okay. All right. Now, if we go back to the formula again, we were told that 40 kgs, all right, 40 kgs were required to produce 100 kgs. 100 units. So 40 were 400 units. 40, that is 40 kgs of B. 40 kgs of B. But now, what about for 200 units? So for 200 units, we just say 200 over 100 units, and these zeros cross out each other, and we come to 80. So in this case, we would require 80 kgs. So this is why we are having the 80 kgs there. All right. So we are saying the 100 units were part of the budget. All right. They were the budget. And the ratio was as given there, where we said we needed 60 kgs for material A and 40 kgs for material B. That was the budget. And in terms of units, we were looking at 100 units in that ratio. However, when now we produce 200 units, we would need to then follow the same ratio, all right, but flexed to the actual output of 200. So this is why we are then multiplying with the 200, and we get our 120 and 80. So the total standard quantity now, if we add 120 plus 80, we get 200 kgs as the standard quantity for actual output. All right. So this standard quantity actually shows that we should have used 200 kgs. We should use 200 kgs to produce 200 units. However, we have seen that that's not the case, because we did not we did not use 200 kgs, but instead we used 210. Let me take the call. Just 1 minute. Okay, sorry for those hiccups. All right, so we have seen that in terms of the ratio was that 1 kg should yield 1 unit. So based on that, we are actually saying 200 units were supposed to have been made from 200 kgs of raw materials. However, these 200 units were made from these 210 kgs. I'm sorry for, obliterating the board. Okay, let me just clean it up. All right, now the standard quantity for actual output is actually an essential metric which we would need as we would be doing the computations. All right, we would need that. It's a good thing to have. All right. Now, let's do the material usage variance first. All right. So for each material, you can do the material usage variance for each material. So if you start with material A, you can see that the actual quantity which was used, in this case, the actual quantity of material which was used as given in the question was 130, and for material B, that's 80 kgs. All right. So we are saying for material A, 130 minus the standard quantity. The standard quantity, we have calculated this one, and we obtained that it was 120 kgs. All right. That's the standard. For 200 units, we need 120 kgs of material A. And then this is the standard price. Remember, we say that we multiply by the standard price, and the standard price is $2 per kilo, is given in this part. Okay, that's $2 per kilo. And then we come here, the actual kgs were 80, and the standard quantity as well were 80, as we have calculated there, right? So that's the standard, and this one is the actual. So 8 kgs minus 8 kg, that's a 0. So obviously we get a 0 variance there, but here we obtained a $20 variance. Why is it is it adverse? It is adverse in the sense that the actual quantities used were higher than the budgeted quantity. The budgeted quantity which we calculated here. Are we together? So the actual 130 is higher than the budgeted 120. So we are going to get a variance that is adverse. All right. Now, there is this confusion that is the formula supposed to be written, let's say, material usage variance. We have written it this way, where we said actual quantity minus standard quantity multiplied by standard price. Is it wrong to say, is it wrong to write the same variance like this? MUV is equal to standard quantity minus actual quantity multiplied by standard price. Can I be marked wrong? You're not going to be marked wrong. What you need to know is the meaning or the essence of the thing, because there is no way you are going to write a variance. This one, for example, this one was 20. The variance for material A was $20 adverse. $20 adverse. All right, just like that. That's how we write a variance. You are not going to write the variance as minus 20 adverse. That's wrong. Okay, so those operations are not going to be seen. They shouldn't be seen. You no need to write plus 20 or minus 20. All right, you simply just put your dollars just like this without an operation, without any sign. Is that clear, ladies and gentlemen? Good. So here, if we are saying the standard quantity was 120, okay, 120 kgs, and the minus 130, which was the actual, okay, this was the actual quantity. All right, so if you separate this, you're going to get a minus, let's say minus 10 multiplied by $2 per unit. We are saying minus 10 multiplied by $2 per unit, and you get your minus $20 dollars. This you're not going to write it even on Excel. You then have to retype manually to say the variance is 20. All right, remove the negative sign. What the examiners want to see is it an adverse or a favorable? So in this case, you are seeing that the budget is saying that 120 kg should be used, but actually we've used 130. So therefore, this variance is adverse. So you need to lead yourself. You need to understand what will be going on with the figures. It's not the arrangement of the formula. The arrangement doesn't mean anything. All right? Whether you have started with the standard quantity or the actual quantity doesn't matter, but you just have to know that inside that bracket, the standard quantity and the actual quantity should regress, should challenge each other to give you a difference. That difference that you need to then to be able to interpret the difference in the sense of understanding variances. If the standard quantity of materials used is lower than the actual quantities of materials used, then there is a problem. Okay, we've used more materials, which is an adverse situation. Starts in adverse variance. Are we together, ladies and gentlemen? Great. So now let me tidy the board. Okay, we've done the material usage. Like I said, you need to calculate this variance per each item, per each material. Right? Now let's do the material mix variance, the material mix variance. Let me use a pen that is all right. So the material mix variance uses the actual total quantity at standard mix, all right, multiplied by the standard price or standard cost, minus the actual total quantity at actual mix, multiplied by standard price or standard cost. Now, like I said, we then have to shorten it. We can shorten it as well to this. Okay, the actual quantity at standard mix minus the actual quantities multiplied by the standard price. All right, you can do that. All right, to ensure that you are not going to be confused. Remember, here it's long because these ones, you know, we have put two, but you can simplify this. You can simplify to just bring the selling price, the standard price outside the brackets. Okay, because as you can see, it is common in both brackets. So we can simplify it to the actual quantity standard mix. Okay, actual quantity at standard mix minus the actual quantity at actual mix, which we just said actual quantity here, right? Multiply by the selling, the standard price. Actual quantity at standard mix. Yes, this one is not clear. It's not clear enough. I'm saying actual quantity at standard mix minus the actual quantity. All right, multiply by the standard price or the standard cost per unit, right? So having that formula is going to assist you. All right, so the actual quantity at standard mix, actual quantity at standard mix, the standard mix was in the production of 100 units, we would need 60 kgs of A for 100 units and 40 kgs of B for 100 units. That was the standard ratio. Those were the standard ratios. But now we then want to flex them to the actual units. Remember, material mix variance talks of inputs. So the figures you are going to use them. Think of inputs. Think of inputs. Whereas the material yield, this one talks of outputs. Please remember that the figures you are going to put in that variance should speak of either inputs, if it is a material mix variance, or outputs, if it is a material yield variance. Okay, so we come back here and say, all right, material mix variance. Material A, okay, here we are looking at the actual total input at standard mix. This one, needs computation, this part, the actual quantity at standard mix, right? That's the quantity of materials used at standard mix. So we use 210. So multiply by the ratio of 60/10 for material A, we get 126. And for material B, we do the same. 210 multiplied by the ratio. Okay, this is the ratio 40/100, and we get 84. All right. So that's the actual quantity at standard mix. All right. Now, so the mix variance now for material A. Remember, by the end of the day, you then have to arrive at the total mix variance, but you need to calculate individually for each material. So here we used 126 kgs. All right, the actual quantity as per the standard. All right, so still this is actually the budgeted standard. All right, the actual quantity at standard mix simply means at budget mix. All right, was 126. So this one is actually, so when you are matching the difference, because remember, variances is about budget versus actual. All right, budget versus actual. But which budget are we talking about? Are we talking of the original budget or the flexed budget? This time, this is a flexed number. This has been flexed. The 126 is a flexed number. So it's a flexed budget. So 126 minus the actual, this is the actual, right? The actual quantity, we get, multiply by 2, we get an 8. But is this 8 an adverse or a favorable? You then have to ask yourself, which one was the budget and which one was the actual? So I'm saying this one is the budget, the flexed budget. Sorry, I don't know what my pen is doing, right? Let me just try to retype the screen again. Okay, so I'm saying this one, that's the flexed, right? The flexed budget. And this one is the actual budget or the actual quantity. All right. So you can see that the budget is lower than the actual. So this is why we are saying $8 is an adverse variance. 8 is an adverse variance. All right, for material B, all right, the budget, remember we calculated this, these are the flexed budgets we are talking about. So for material B, we discovered that the flexed was 84, but actually we used 80. So this one should be favorable. That's favorable, isn't it? So you see the favorable here, that one was adverse. Okay, so we ended up the adverse 8 plus the favorable 12. So you know mathematically that the adverse is negative. So minus 8 plus 12, that's 4. That's 4 favorable. So the ultimate variance, the total mix variance was favorable. Okay, good. Now let's talk of the yield. I said we need to look at the output. So the most important computation is the expected output from actual input based on standard yield. And we know as well that this variance can be shortened as well. The way we did for the material mix variance, we can as well do it for the yield variance. So we are looking at actual quantities at standard mix minus the standard quantity. Actual quantity at standard mix minus standard quantity, okay, multiplied by the standard price. Okay, now the reason why I say that we need to look at outputs is actually legendary. Okay, is legendary as you'll be looking at this variance. Okay, The expected output from actual input based on standard yield. We know that the standard yield was that 100 kgs of input was to yield 100 units of output, and that ratio we have already talked about it. Now the actual output, the actual input was 210 and expected output was 210. All right, so using total standard cost per unit, we then have to calculate the yield variance. So the standard cost per unit was that 60 kgs multiplied by $2 per kg plus 40 kg multiplied by, this one has been given in the question, remember that. Okay, this one that's the standard cost per unit. Okay, remember we are talking of 100 units in this case, all right, and they are units, all right. So for cost related to material A, we are talking of 60 kgs at $2 per kg, that's 120, all right, and then here 40 multiplied by 3, that's 120, isn't it? So if we add, we get 240. Okay, that's $240 per 100 units. But now per unit now becomes 240 of 100, that's $2.40 per unit. Are we together? Good. So this is the standard cost per unit which we are talking about. All right, the 240. All right, and I'm sure you've seen how I've computed it. I said 60 multiplied by 2 plus 40 multiplied by 3, which gives us 120 plus 120, which gives us 200 over 100 units, which gives us $2.40 per unit. Now the yield variance, which is the actual output minus expected output multiplied by standard cost per unit. Now the computation is complicated in determining the expected output. But the expected output is only, we have done the expected output already. Why? Because the moment we discovered that the ratio was 1:1, we automatically solved that problem, right? Because we were expecting to see 1 unit producing, 1 kg of raw material producing 1 unit, because the ratio was 1:1. So in that case, 210 kgs were supposed to produce 210 units. That's our expected unit, which is our standard quantity. Okay, that was the standard or expected quantity. All right, but what happened was we produced 200 units. All right, we produced 200 units when the expected units were 210. So the expected units, these ones, are the budgeted quantity or the standard quantity. That's our budget. All right, based on the ratio, the standard ratio of 1:1, right? Are we together? We were expecting to produce 210 units from 210 kgs. That was the expectation. Okay. Now, the actual quantities were 200 units. So in that case, we are saying actual minus expected of 210, the actual is lower than the expected. All right. Remember I said, these are outputs. these are outputs. This actual quantity, this one, the actual quantity we are talking about is the output, not inputs. If you look at them as inputs, you're going to get a favorable variance, because you are going to say the actual inputs were 200, but the actual inputs were 200 versus the standard inputs of 210, or the budgeted inputs of 210. So therefore the inputs were lower than the budget, and to give a favorable variance. In that case, you'll be lost. These are outputs. When we are looking at the yield variance, we are looking at the outputs. So in this case, the output, the actual output was 200 units, when the expected output was 210. This is why we are going to have an adverse variance. Are we together? So let me clean up the screen. So we are saying here that the yield, material yield, variance, okay? We are saying actual quantity minus standard quantity or expected quantity multiplied by standard price or cost. Okay, so the actual quantity of output, remember, I don't know how to write this, of output minus standard quantity of output or expected quantity of output. Okay, so here we are saying the actual quantity was 200 units, actual quantity of output, versus the standard quantity of 210. Okay, and we get a $10 difference. Okay, $10 difference. And you ask yourself, if this is actual and if this is budgeted quantity, so the actual output was low, so obviously this is an adverse variance. Okay, all right. I'm sorry for that. These are units. Sorry, the 10 is actually in units. These are 10 units. Then you have to multiply by the standard price. The standard price, ladies and gentlemen, we have calculated it here, right, as $2.40. So you just have to multiply the 10 by 240. But the information about whether it is the adverse or variance is found in the bracket, inside the bracket. That's where that determination is. You need to lead yourself. So if you multiply 10 by $2.40, you are going to get $24. All right, but for you to decide whether it's adverse or favorable, you need to use information inside the bracket there. That's where the variance was determined. So inside the bracket, you ask yourself which one was the budget and which one was the actual. So the actual was 200 units of output versus the budget output of 210. So you can see that the output is lower than the budget. In that case, this is an adverse variance. Is that clear? Good. Now, hey, that's it. So these are the interpretations. So if we add the material, the variance was favorable. The material mix variance was $4 favorable. Mix was $4 favorable, and yield was 24 adverse. So you can see that the MUV should be 4 minus 24, because an adverse is a negative variance, isn't it? So for that we rest at 20, which is adverse. So when we computed our material usage variance, we obtained 20 easily. So that's why I say that it's healthy to compute the material usage variance when you are computing the material mix and material yield variances. I hope, ladies and gentlemen, I have uh, helped you, and we need to then understand that as we proceed with the lecture. So we need to jump on to another issue here. This example has been taken from the Kaplan study text, and we need to compute the material yield variance as well. Okay, so you can pause the video and do the computations on your own, and then I'll assist you later on. Let's do that for now. Hello, good people, how are you? I hope you are still with me in this journey towards the understanding and mastering of standard costing and variance analysis. Okay, so this question has been adapted from the Kaplan study text. It is called Honju. Okay, Honju. So, in this particular question, we are required to compute the material yield variance, okay, the MYV, all right? And we know that this variance is given by the actual quantity of output, okay, minus the expected output from actual quantities of materials used. So the expected output, okay, normally I call it the standard quantity. Okay, let me just say expected output or expected quantity of output from actual materials input or actual materials used. All right, expected quantity of output, or multiplied by the standard cost or standard price per unit of raw materials. Okay, now let us find information to fill in these variables so that we calculate our variance. So let's read the question. Honju operates a standard costing system. The standard direct materials to produce 1,000 units of output is as follows. Okay, so we are given the standard or the budget information. This is the budget. Okay, that's the budget. But this budget gives us more information about the ratio or the mix, the standard mix or budgeted mix. All right. So to produce 1,000 units of output, we need material A in the ratio of 600 to material B 240 kgs to C 360 kg. So in total, if we add up these figures, we are going to get 1,200 kgs in total. So our ratio is 1,200 kgs give us 1,000 units. 1,200 kgs give us 1,000 units of output. But during April, the actual output of the product was 21,000 units. The actual materials issued to production were material A, 14,000, material B, 5,500, material C, 5,500. So if we add up these, okay, if we add up these items, we can safely see that we utilized 25,000 kgs to produce 21,000 units. All right, so we need to compute if what we did was actually in line with this ratio, because the original ratio was saying 1,200 kgs to 1,000 units. That was the ratio. Okay, so for the benefit of our computation, so far we have found, we are given by the examiner one of the variables. The actual quantities of output is 21,000. What about the expected quantity? The expected quantity, ladies and gentlemen, we know that to produce 21,000 units, we used 25,000 kgs. All right, but how much were we supposed to expect from 25 kgs? So from 25 kgs, given this ratio, we should have obtained 25,000 over 1,200 kgs multiplied by 1,000 units. We want to determine the number of units we would have expected. So in this case, this should give us how much? If we punch those figures into our calculators, that's 25,000 over 1,200 multiplied by 1,000. So we should have obtained 20,833 units. So if we had used 25,000 kgs, all right, yes, if we had used 25,000 units according to our budget, we should have obtained 20,833. So you can see that the actual quantities of 21,000 are actually higher than the expected, which is 20,833. So automatically this should be a favorable variance. This should be a favorable variance, an F. Is that clear, ladies and gentlemen? Just using by elimination in a multiple choice question, if all other choices are in an adverse, then you should have picked the one without doing the rest of the computation. You just have picked one that was favorable. Okay, so we then have to compute the standard price. What is this amount? The standard price. How do we arrive at the standard price? Remember, we have been told that to produce 1,000 units, we needed this mix at this standard price per material, per kg of the relevant material. So to arrive at the cost of the finished product, unit of finished product, we just have to multiply across, isn't it? Okay, we use simple arithmetic this time. That's 600 multiplied by 110. We multiply this, 240 multiplied by 240 multiplied by $2.40, and then 360 multiplied by $50. So we need to get something here, right? We need to get 600 multiplied by 1.10, how much is that? Let me use the calculator here. 600 multiplied by 1.1, this gives us 660. And then 240 multiplied by $2.40, that's 576. Excuse me, I just want to, because that's 576. You know, when I delete, everything goes away. So please allow me, be patient. And then 360 multiplied by $1.50, that's 540. So here it's equal to 540. So if we add 660, 576 and 540, how much do we get? That's 660 plus 576 plus 540. We get the total standard cost becomes 1,776 over a total of 1,000 units. This means the cost per unit should be $78 to the nearest 2 decimal places. That's 1.78. So each unit is $78. So that's, we put our $78 here as part of the variance, and then you compute and get your favorable variance of how much. So we are saying 21,000 minus 20,833, we get 167 minus $70. Multiplied by, it's multiplied by $78. So the ultimate variance, that's 297.26. This is favorable. Okay, that's favorable. So, ladies and gentlemen, that's how we do these computations. All right. You can replay the video, try to get the sense. Okay, I have written all these workings here so that you get what we are talking about. Okay, initially you need to determine the ratio. Okay, we had computed that in total these units, okay, let me just go back. All right, so you have to add and arrive at these ones. That's 1,200 kgs in total, right? And these are the 1,200 kgs we are talking about of inputs for the production of how many units? 1,000. So that gives you the baseline ratio. Okay, and then we determine that the actual outputs were 25,000 for the the actual inputs for the 21,000 output were 25,000 kgs. So these were the outputs, and those were the raw materials which were used in the actual production. All right, and the question is this in line with this original ratio? And we determined that yes, it was in line. It was actually favorable in the sense that the materials which were used should have produced lesser than 21,000. However, we produced 21,000, which was above the budget. This is why we ended up having a favorable variance. There was more yield than expected, isn't it? All right, so the actual output, 12,000, expected output from actual. This is why we did the flexing now, because the original ratio was 1,200 kgs for 1,000 output. However, for the 25,000 kgs now, we then have to put the 25,000 as the numerator above the like and like. You understand? Kgs over kgs. All right, and to multiply by the number of units from the original ratio. And then we arrive at the flexed. That's the flexed budget, because it is flexed in the sense that we are actually trying to bring the actual production to the budget. okay, the actual production to the standard mix, because the standard mix was 1,200 kgs to 1,000 of output. Okay, so that was the standard ratio which was in existence. Okay, that's it. So we obtained the difference here, and this is what was the difference, which is the variance. Of course, this one is still the difference. All right, it's not yet the variance, because the variance has got some monetary figure. All right, we then have to multiply the 166.67 units by the standard price, and to compute the standard price, we then had to multiply. This was for material A, and this one for material B of inputs, the standard costs of inputs from the inputs table. Okay, 600 multiplied by 1.1, 240 multiplied by 240, 3 skis multiplied by $1.50, something like that. That's what we are talking about. And we arrived at that as the total for the 1,000 items. But now we wanted the standard price of each item. This is why we divided by the 1,000 there, and we obtained that amount. All right, then the yield variance now becomes the difference multiplied by the cost per unit, and we arrive at this, which is favorable. Now the comment. The favorable yield variance indicates that more output was achieved from the actual quantity of materials used than expected based on the standard yield. The standard yield, ladies and gentlemen, was 1,000 kgs should produce 1,000 units of output. Based on that, we could see that the 25,000 kgs, when they produced 21,000 units, that was a favorable. We were expecting to have only produced those items. Are we together, ladies and gentlemen? So that's the materials yield variance for you. Ladies and gentlemen, we need to do this question. Okay, it's something that is very important for understanding of material mix, yield, and usage variances. Okay, so we hope we'll polish up with this question, okay, before we talk of other variances. All right, I know we might be confused due to the lack of consistency in our use of formulas, but I want you to be rest assured that you just have to understand the idea for now. Okay. The scenario itself will tell you which formula is or should be used. All right. So, not every question is going to come the same. They are always going to be different. Okay. So, Green Glow Paints Limited manufactures a special eco-friendly coating called EcoShield. So that's the name of the product, which is produced using 3 types of base components. The standard cost information for producing one batch of EcoShield is as follows. Okay, so that's our budget where we get the standards. So component type C1, C2, C3, and these are the quantities to produce an EcoShield. We need this ratio 8:5:3, right? And this in total is 16. So we need 16 kgs to produce one EcoShield. Okay, and these are the cost per unit of materials per each component. It is anticipated that 10% of total input will be lost during production. For the previous week, the actual output achieved was 15,408 kgs. The actual quantities of materials used were those months. So these were the actual outputs. All right. But we are told that if we used 16 kgs as inputs, okay, we must expect a 10%. So, which means the actual output should be 16 kgs multiplied by 90%, which means we are talking of 14.4 kgs of output. Okay, so our ratio is 16 as to 14.4. Is that clear, ladies and gentlemen? Good. So let's determine variables for the material mix variance. The material mix variance. This variance requires a lot of computations, but we just have to go step by step. All right, we know the formula. The material mix variance is given by that's the actual quantity, a standard mix, minus actual quantity multiplied by standard price. Actual quantity at standard mix minus actual quantities, that one. That's the mainstream. Let me just take you back a bit on this formula. Sorry. Yes, this is the formula we are talking about. Actual quantity at standard mix minus actual quantity at standard multiplied by standard price. So, sorry for that. Okay, so bearing that in mind, we can proceed. The figure we need is actually to construct figures relevant to the actual quantities in standard mix. All right, so let us remember these are quantities of inputs. We are talking of inputs. So this is the standard cost card, all right, 8 kgs of C1 at 30 cents. All right, and this should be, let us determine the standard cost per unit. Remember, we need to compute that as well, isn't it? But usually that one, the aggregate standard price per unit is essential in the computation of the yield variance. For the material mix variance, we want the unit cost per each component, and then we add up, we come to the total material mix variance. Are we together? The material mix variance. So for now, we can skip that process for now. So here we get the total standard input per batch, where we added everything and determined that we need 16 kgs to produce an eco-friendly, the eco shield. All right, we need 16 kg. However, there is a 10% normal loss, which means we will need a standard output would be 14.4 kgs. For each 16 kgs of raw materials, we are going to get 14.4 kgs of output. That's the standard. All right. Now, the total output from the question was given as 15,408 kgs. That was the actual output, all right? And it had been obtained from a combination of C1, that is 8,284 kgs, C2, 7,535 kgs, then C3, 3,334 kgs, and that's when we obtained the 19,153 kgs. Those were the inputs. But we do not know the ratios in each of those quantities. So we need to come up with the redistribution, the revised quantities in terms of the standard mix. Are we together? It's very important. All right. We have been told that these were used, but were they in line with the standard mix? So we need to do that computation. We can skip this part for now because it is related to the computation of the materials yield variance. So for now, we can skip that one for now. So let's talk of the standard proportions. All right, standard proportions are going to be determined using the actual quantities used. So we have been told that the actual quantities were in total 19,153, and we have obtained that from this information here. Okay, this information, we added these and obtained our 19,153, isn't it? Yes, 153 kgs. All right, but we want to construct our own mix using the standard mix, using this ratio 853. Okay, so this is why we come here and do the standard mix proportions. Okay, so for C1, that's 8 kgs over 16 kgs in total. We get a 0.5 ratio. And for this one, for C2, that's 5 over 16, 5 over 16, and we get that one. And the C3, that's 3 over 16, and we get that one. We then have to multiply by the total of figure. The total figure kgs were 19,153, the actual kgs utilized. So we redistribute this according to proportions, and we get this type of distribution. Then with that in mind, we can construct a table. All right, this table then becomes, let me just say, these become the revised budgeted quantities or standard quantities, the revised standard quantities. All right, and these are the what we call the actual quantities per standard mix in our formula, because we say that the material mix variance is equal to actual quantities at standard mix minus the actual quantity multiplied by SP. You understand? So these revised quantities have been flexed in relation to the standard as well as the actual activity. All right, so we have flexed them. All right, so those are the revised quantities. All right, so these becomes the budget. The revised quantities or standard quantities are the budget versus the actual. It's very important because when you determine whether this one is favorable or adverse, you need to have the budget versus the actual. So the flexed budget is that one. So we are saying we had determined that C1 from our computation, the C1, the revised standard quantity was 9,576.5. Okay, this is the figure. All right, and the actual was 8,200. You can see that the budget was higher in terms of inputs. It wanted us, or it required us to have 9,566. However, we used only 8,284. Okay, in the production, and this is why it is favorable there. Then we multiply by the cost per kg of 30 cents, and we have our ultimate variance, which is favorable. We come to C2, okay, we have got 5,985, as inputs according to the budget, the revised budget, but actually we used 7,535. This should be adverse. Okay, that's adverse. The difference is negative there, right? But the variance itself should not have a negative sign there. If you do that, you're going to fail. Simply write the positive, okay? Don't put any operative there. Then put an operation, right? So it should be 774.85, and in bracket you put your adverse, your A, showing that the variance is adverse. You come to C3, you do the same according to our computation. And the computation we are referring to is this computation. We obtained that C3 required a revised quantity, budgeted quantity or standard quantity of 3,591.2 kg. However, actually we used 3.3. This is favorable because we used low inputs. So we obtained a favorable variance, and we multiply by the cost per kg according to the question, the standard cost, and we obtained this ultimate variance. So for the material mix variance in total, we are going to add all these in the variance column, and we arrive at the 284.22 adverse. Why is it so? Because you can see here that the adverse variance was quite larger, right, versus the favorable ones. So the ultimate variance should be adverse as well. Mathematical, isn't it? Arithmetical. Okay, now the trouble causer, right? The trouble causer, ladies and gentlemen, is the materials yield variance. Now we know, or we have already learned so far, that the materials yield was given, okay, the MYV was given by the actual quantity in actual mix, actual quantity of output in actual mix of input, right? Okay, I had indicated that we use the actual quantity minus the expected output or expected quantity of output, or budgeted quantity or standard quantity of output from standard mix, all right, from the standard mix, all right. And this, as you can see, this is almost similar to what we are talking about, right? So the actual quantity of output, all right, multiplied by standard price. All right. What am I saying? Initially, this I was referring to outputs, all right? Outputs. Okay. Now, in this case, we are using the inputs, all right? Yes, we have been given information in relation to the actual output, okay? The actual output was 15,408 kgs, all right? But if you come to step 2 there, step 2 is saying that the standard input for actual output. To get this 15,408 kgs, we should follow the original ratio where we said that 14 point, actually it's 16 kgs give us 14.4 kgs. All right. Now we are told that the the actual output was 15,408 kgs. And this was obtained from, 19,153 kgs. All right. But what was the standard expectation? Or what were the standard inputs to obtain this amount, this output? How much were the inputs required to obtain that, those outputs? How many units or how many kgs of inputs did we require to come to that output? So given that 16 kgs have to be subjected to normal loss and we obtain 14.4 kgs, therefore the standard input should be 16 over 14.4, all right, multiply by the 15,400, and we arrive at that much. All right, so you can see, all right, even if we are looking at the inputs themselves, we can still compute the yield variance. Okay, I will use the same method to use the outputs themselves and still come to the same conclusion. Don't worry, I'll do that. This is why I'm there, isn't it? Good. So, we have obtained the standard input of 17,120. That was the budgeted input. However, the actual input was 19,153. So using that alone, using that information alone triggers us to some conclusion. Okay, these were the actual units versus the expected quantities. Expected quantity, all right, of inputs. This was the actual inputs, okay, minus the expected quantity of inputs. All right, so the expected were 17,120. However, we used 19,153 kgs, so the difference should be adverse. We used more when we were supposed to use less. So we then have to multiply by the standard price. Here we have just said weighted average standard price because we are going to weight. The process we have been doing so far was to weight. We are waiting because the standard mix was we need 8 kgs of C1 at 30 cents per kg plus 5 kg of C2 at 50 cents per kg plus 3 kgs of C3 at 40 cents per kg, all divided by 16. All divided by 16. And we have to come to a cost per unit of 38 cents. All right. Why are we dividing by 16? Because if we are looking from the eyes of inputs, the inputs were 16 kgs in total. All right. But you will see when we are now using the formula where we'll be looking at outputs, we are going to use the inputs after the normal loss. We're going to use the input cost after factoring in the normal loss, which is we are going to use the 14.4 kgs instead of dividing by 16 kgs. Is that clear, ladies and gentlemen? Good. So in this case, we are going to say 2,033 kgs multiplied by 0.38125, and we arrive at an adverse variance of $775.1. Okay, so our MUV, is given by MMV, that is the material mix variance plus the material yield variance, and we arrive at that adverse variance. Okay, now let us do the question using the formula we have been working with so far, because consistency is the key. All right, so we are talking of the material yield variance. We say that it was given by actual quantity minus standard quantity or expected quantity, all right, of output, expected quantity of output from standard inputs or standard mix of inputs, something like that. All right, and remember, this is the flexed amount based on the budgeted mix ratio. Okay, the actual, the expected output from the standard mix, right? What we were expecting, multiplied by the standard price. Okay, so we know that the actual quantity here was 15,000 watt. It was given in the question, the actual quantity. Okay, the actual quantity was 15,408. Okay, this was the actual output. If we're talking of output, isn't it? The output to output. I think that that should be the fairer way of presenting the information. Okay. Okay. Now, if we come back to our computation here, all right, our computation tells us that the actual input was 19,153, if you still remember, as you can see on the screen. Okay, and we obtained this that figure from adding this, where we get 19,153 kgs. All right, now with that computation, we are also aware that these inputs were subjected to a 10% normal loss. So the actual output, the expected output should actually be 19,153 multiplied by 90%. And this should lead us to 19,153 multiplied by 0.9. This leads us to 17,237.7 kgs. That's the expected output, 17,237.7. We then have this is why I said every question is unique. Do not be blingered and come with your formula. You'll be dazzled on examination day. All right. So now the standard price we are going to use. Remember, initially we had calculated the standard price using this amount and we had obtained this one. This one, if you use that one, you are going to be marked wrong. Okay, everything is fine here. All this is okay, but the denominator is not 16. Why? Because the figures we are using have been subjected to the 10%, have been subjected to the 10% normal loss. So we are going to use an adjusted figure. So we come here and say we take this 2 plus 2.4 plus 2.5 plus 1.2, which is 6.1, okay, divided by 14.4. Why? Because the 14.4 is the amount that has been subjected to the normal loss adjustment of 90%. So we're going to say 6.1 over 14.4, okay, to get the cost per unit or the standard price. So we say 6.1 divided by 14.4, and our unit cost becomes 0.424 to 3 decimal places. So we take that one and multiply it here. That's 0.424. And the ultimate, okay, forget about this, don't be confused there. The ultimate equation there, or the difference should be 15,408 minus 17,237.7. That's 1829.7. All right. Multiply by $0.424. Okay, and this should give me, or here there is a negative from this. The difference there is a negative. Okay, arithmetically it's a negative arithmetically. Okay, but that negative sign should not be taken at face value as an adverse variance or an adverse difference. All right, for now, just to chill, finish everything, and then you breathe in and out. So let's multiply that figure by 0.424, and we get 775.79 dollars. Okay, like I said, the ultimate variance need not to have an operation minus or plus there. Don't put it. Then after that, you then come back to the bracket and say, bracket, who was the budget and who was the actual? The budget is this figure and the actual is that figure. Okay, and what are we talking about? We are talking of material yield variance. Material yield variance. So the material yield variance is talking about what? It's talking about outputs. It's talking about what? About outputs. So if the material yield variance is talking about outputs, then I must ask myself, okay, which figure is giving us much? Okay, so the budget is giving us much, but the actual output was a lesser amount. So this should be an adverse variance. Okay, that's an adverse variance. And one thing for certain, we have done our computation correctly. You can as well verify from the figures which we have already calculated before using the other method, the input method. Okay, we as well arrived at an adverse variance of 775.10. Okay, you just have to know what is going on within a question. Do not be confused or hoodwinked by the tricks examiners would use. Sometimes it's not actually given on the silver platter. You need to maneuver your path, your way through the jungle until you reach the treasure island. Treasure island. Okay. That being said, I think we need to migrate to something else, something different from these. Those with notes, I'm sure there are a lot of things, a lot of text which I've presented, which could be essential in your studies to understand these variances. Okay, you can continue further from where I left, but I think for now, you guys are now comfortable computing these variances. Okay, there was a part where we talked of the computation of the material usage variance, not using the addition of material mix and material yield. Can we as well compute the same figure of the material usage variance using its own variables or its own formula? Okay, we can do that as well. All right, remember the standard quantity, this SQ, was given as 17,120 in the computation. Remember when we computed for that standard quantity, all right, here where we say that we know that the actual output was that one, but the standard input now, the inputs reflect which give birth to that output were found to be 17,120. If you still remember that. Okay. Please note here. Remember, because for us to obtain 14 kgs, we need 16 kgs of raw materials. For us to obtain output of 14.4 kgs. Okay? So if we are given an output, obviously the inputs have to be grossed up. We need more inputs for a lower output. That's the standard, isn't it? That was the standard where we said 16 kgs for 14.4 kgs of output. So to get more output, the 16 should be on top divided by the output so that we get more inputs. Remember, we need more inputs. So we need to gross up the output to reflect the more inputs we need. And these were the standard inputs. Okay, the standard inputs were 17,120. All right, so the standard inputs or standard quantities are 17,120. All right, so we then have to break down this quantity in terms of the distribution. Okay, in terms of the budgeted mix. Okay, sorry to use the word distribution, but we need to prorate in terms of the ratios or the proportions given, all right, or the mixes ratio. Okay, so that's what we are doing there. All right, now after doing that, we then have to still continue with the computation where we talk of the actual quantities being regressed against the standard quantities, all right, and we multiply the difference here. We multiply the difference by the standard price per unit. Okay, that's what we are doing here. That's what we are doing. And we arrive at a variance initially that is favorable for C1, and for C2 it's adverse. For this other it's adverse again. All right, so that leads us to a material usage variance of $1,059.30 adverse. Right? Is this different from what we had computed initially? Initially, we had computed what? This was what we had computed. So you can see that our computations have been very, very correct. Okay, we have proved that those wider issues should be read. Okay, should be read because in the examination they are going to come on those discursive parts of the questions. All right, so when we want to change the material mixes, we should look at the cost impact. The primary driver for changing mixes is often to reduce costs by using cheaper substitutes. However, this might lead to increased usage, affecting the yield or impacting other cost areas. So you need to bear that in mind. Also, you need to consider quality issues. Okay, sometimes when you change the mixes or the combinations, you might as well adversely impact the quality of the end product, and this might annoy your customers and you might be thrown out of business. So you need to balance those issues or those decisions with what is good for your business. Sometimes it's good to save costs, but it might not be as good in terms of the quality, the ultimate quality of your product. Performance measurement. Favorable mix variances might mask underlying problems if the new mix leads to lower yield or quality issues. Performance measures should consider not just cost variances but also quality metrics. For example, defect rates, customer complaints, and efficient yield. Focusing solely on mix variances can create a short-sighted view if wider implications are ignored. Usage mix and yield are the connection. Total material usage variance. This represents the overall difference between the standard cost of materials that should have been used for actual production and the cost of materials that were actually used. Material usage variance, as we have seen, is equal to material mix variance, MMV, plus material yield variance, MYV. Explanation. The material mix variance isolates the impact of using a non-standard combination of materials for the total input. The yield variance isolates the impact of achieving a different level of output than expected from that total input. So yield is more of efficiency. Together, these variances explain the total difference in material usage compared to the standard required for the actual output. A change in mix can directly influence the yield achieved. For example, using a cheaper, lower grade material might lead to more waste and lower yield, even if the mix variance itself appears favorable. Okay, that's for you, ladies and gentlemen. Now, there are alternative methods of controlling production processes. We might use statistical process control techniques, right? Where it becomes essential to monitor and control processes using statistics. Control charts track process variations over time identifying when a process is out of control and requires intervention. Justification for using statistical process control is that it focuses on preventing defects rather than just identifying them after they occur, as in the case of variances in most of the times. It provides real-time monitoring and early warnings of potential problems. Total Quality Management, TQM. A management philosophy focused on continuous improvement involving all employees in the pursuit of quality, emphasizes process understanding, defect prevention, and customer satisfaction. Justification for TQM. It creates a culture of quality and continuous improvement, addressing the root causes of inefficiencies and waste, leading to better overall control. What about just in time? This is quite common, isn't it? The JIT is a production system where materials are received and products are produced only when needed. Aims to minimize inventory holding costs and waste. Justification for JIT. It forces efficiency and reduces waste by eliminating buffer inventories that can mask production problems. Highlights inefficiencies quickly. However, we know the downside of JIT is that you need to have stringent, top-notch, ideal supply chain networks and efficiencies which might not be easier to obtain. In a world where we have developed and developing countries interacting, to maintain a JIT system is quite evasive and not palatable or not feasible. So, it as much as it is good, it might just be a dream rather than reality. Lean manufacturing. This is a systematic approach to eliminating waste, muda, in all aspects of the production process. It focuses on value stream mapping, pull systems, and continuous flow. Justification. It streamlines processes, reduces lead times, and improves efficiency, leading to better control over resource utilization. For the purposes of this paper, all you need to do is to show the examiner that you have come across this during your study journey. Do not, show the examiner that you haven't touched anything about these issues. Okay, so once again, they are part of discursive questions. Yes, of course, in multiple choice questions, you might be asked about them. You need to show your general understanding of the issues. Otherwise, do not waste much time on them. All right, let's move on. Now we have got another variance in the room, or another area of variances in the room, which is normally tested in our examinations, the sales mix and quantity variances. When are they applicable? These are applicable when a company sells multiple products. All right. I'm very glad in the previous week we have been talking of the profit volume analysis, where we talked also much about the sales mixes and so forth. But now we are looking from the angle of variances. So there is a main parent variant in the sales arena called the sales volume variance. This is the difference between the budgeted profit or contribution. If you are in a marginal costing environment, we talk of contribution, and the standard profit or contribution at the actual sales volume using the original budgeted mix. Sales volume variance is equal to actual quantities sold minus the budgeted quantities multiplied by the standard profit or standard contribution. Then sales mix variance. This measures the impact on profit or contribution due to selling a different proportion of products than the standard budgeted mix for the actual total sales quantity. Okay, the sales mix variance is actually essential because it informs you on which products or which combination of products maximizes sales. All right, some combinations are not good at all. This is why you hear vendors sometimes they tell you, no, you must sell this type of myel. But if you have got only one type, you are going to lose sales because customers tend to buy where there is variety. But on those varieties, you then have to at least include varieties which support each other. Otherwise, if you are having a wrong mix, you might end up selling none. Okay, so sales mix variance is equal to actual total quantity at standard mix minus actual total quantity sold at actual mix multiplied by standard contribution or profit. If this variance is favorable, it means that more of the higher profit or contribution products and less of the lower profit or contribution product were sold. Okay. If it is adverse, then less of the higher profit or contribution products and more of the lower profit or contribution products were sold. All right, understand this terminology, because if you write your answers as if you are answering an English composition paper, you'll be running the risk of obtaining a 46% in every ACCA Performance Management examination. So be mindful of your jargon, of your grammar. Your command for the cost accounting language. This is not English grammar per se, but something that is of specialty. All right. So your vocabulary should reflect some nuances exhibiting maturity in costing or maturity in management accounting. Then there is a sales quantity variance. This measures the impact on profit or contribution due to the difference between the actual total sales quantity and the budgeted total sales quantity using the standard or budgeted sales mix. Okay, sales quantity variance is equal to actual total quantity minus budgeted total quantity multiplied by standard profit or contribution. If the variance is favorable, then it means more units were sold in total than budgeted. If it is adverse, then fewer units were sold in total than budgeted. Okay, let's talk of these variances with an example to see if we can mark or if we are mastering the concepts. Jack's Motor Car dealership has the following sales information for the month of March. Motor vehicle type, Honda. Okay, we're not talking of the Honda Fit or Honda Airwave or what. I mean, we are not particular. We are not interested in those things. All right. We're just using these just for hypothetical analysis. So, motor vehicle type, standard contribution. So, if you hear the word standard contribution, therefore, even if you then, in your computation, then know that this is a marginal costing environment. All right. Budgeted sales units and actual sales units. Required. Calculate the dealership's sales mix, quantity, and volume variances for the month of March. We already know the sales mix and quantity variances are a breakdown of the sales volume variance, SVV. We know that. All right, remember when we talked of basic variances earlier on, we referred to the SVV as the total variance, that is the mother of sales mix and sales quantity variances. Okay, and the sales volume variance is given by the actual quantities sold minus the budgeted quantities multiplied by the standard contribution. Okay, so from the question, let's construct the budget as well as the flexed budget. All right. Now, sorry. Okay. The budget was 5 units of Honda and 1 unit of Mercedes-Benz. So 5, 1. Okay, multiplied by the contribution per unit. The contribution was 20, here is 90. So 20, 90. So obviously here the budgeted contribution is 100, and here that's 90. Okay, and in terms of yes, so we are looking at 190 as the budgeted contribution. What about the flexed contribution? Okay, remember we flex the actual. All right, so what was the actual sales? Okay, we are talking of 2 Hondas and 3 Mercedes-Benz cars. So 2, 3. So the actual was 2, 3. All right, and these have to be subjected to the standard contribution. Right? Remember, we are talking of standard contribution, which stays at 20 for Honda and 90 for the Benz. So this comes to 40 to 70, and we obtained 310. Okay. So the formula, okay, for the sales volume, we have obtained the sales volume variance for now, okay, because this is the difference between the budgeted contribution less the flexed contribution. All right, you might say, why are you saying so? Because the actual formula we have stated was that it should be actual quantities sold minus budgeted quantities at standard contribution. All right, here we flex the actual. We are flexing the actual. We have flexed the actual. So the actual quantity sold was this much. Right? In terms of the figures, I don't think you need to add up and say 5. Why? Because to add them directly like that shows that to some extent you are not understanding the idea, because these cars are different. Okay, the cars are different. You can't say we have sold 5 cars. It's not more informative. It will be like misleading, adding Honda and Benz. All right. So, what shall I say? Actually, the actual quantities sold in their standard mix. Okay. All right. Um, that's your AQ sold, that variable. Okay. One more thing. You need not to be worried about the terminology per se, but you just need to understand what will be going on. Okay. You need to flex that contribution. You need a flexed contribution. Okay. In that contribution, there are actual quantities. Yes, there are actual quantities. That is 2 Hondas and 3 Mercedes Benz, but then you have to multiply them with their standard contribution, and you arrive at 310. So the difference between this amount and that amount is going to give you the sales volume variance. Okay, so what is the difference there? 190 minus 310. This gives us 120, which is favorable. Okay, the budgeted quantity, this one has been done well. Okay, this one, that's the BQ, right? And this one was the AQ sold from the variables there. Okay. Okay, now for the sales quantity variance, ladies and gentlemen, we need to come to a revised budget. Okay, I understand. Initially, I told you that sometimes to add up these totals, the actual quantities and budgeted quantities, is to some extent going to be misleading or not reasonable. It is also essential that as you leave the premises to go to your market to sell something, you need to know the quantities, because it is from those quantities that how you ration, how much of jeans shall you have to display, and how much of shirts, how much of boxer shorts you need as well to display. And by the end of the day, you need to totalize and say, I've got so much items whenever I go for the display, or when I put my clothes on display. You need to account for those quantities as well. Because when we talk of the quantity and the mix, we cannot, excuse ourselves from itemizing the items. So initially, the budgeted contribution was obtained as 190, and this was from a budget of how many? We were looking at 6 cars in total, and we were aiming to get a contribution of 190. However, what obtained on the ground was that we obtained 310 from how many? From 5 cars. So we need to revise our budget. Okay, we are revising this budget, all right, to bring it to reality using information informed from the flexed budget. Am I talking to somebody? Okay, we want to revise this contribution okay, of 190, we want a revised contribution using the reality of 5 cars out of the budgeted 6. So the revised contribution now, the revised contribution should be how much? Revised contribution should be the revised contribution revised with the calculator. Okay, we're talking of 190 multiplied by 5 over 6. So we are looking at 158.3. That's the revised contribution, ladies and gentlemen. Okay. Okay, so with these figures, I have my pens here. I thought I was going to have some special pen. Okay, good. So I now have 3 different figures. I have got that one, I've got this one, and that one. Okay, now for the sales quantity variance, all right, I need the budgeted quantity, okay, the budgeted quantity minus the revised budgeted quantity. Okay, yes, something like that, and I multiply by the standard contribution. Okay, now because all the quantities have been taken care of and what we are having are just these contributions. So the budgeted contribution minus the revised budgeted contribution, okay, should give me the answer. So 190 minus 158 should be the answer I need. So that's 190 minus 158.33. Then I get the variance of 31.67. Now the question that comes is this favorable or adverse? My original budget was saying I should obtain a contribution of 190. However, we have revised the budget downwards using the actual things which were obtained on the ground, and we revised the contribution to 158. Now, if we have revised the contribution downwards, that should be an adverse situation. Is that clear? Guys, we are saying we are still in the budgeting area. Okay, the budgeted contribution and the revised budgeted contribution. Initially, according to our budget, we were aiming for a contribution of 190. However, our revision has shown that the contribution we should aim or we should look at should be lower. Is that a favorable or an adverse development? From the planning perspective, that should be an adverse variance. Okay, so the sales quantity variance is adverse. Is that clear, ladies and gentlemen? Yes, that's how it is. Okay, that's how it is. Don't worry. We are going to do a comprehensive question, but it will be another video where I'll be going through a comprehensive long question with all these variances, then we seal the deal together. All right. Now, for the sales mix variance, we are going to take the revised budget. This is going to be the revised budget minus the flexed budget. Okay, so we're going to say this is 158.33 minus 310. And this should give us how much? 158.33 minus 310. This gives us $151.67. Is this adverse or favorable? All right. The flexed budget, ladies and gentlemen, is more of reflective of what is obtaining on the ground, what has been sustained on the ground. Our revised budget was looking at a contribution of $158.33. However, actually, according to the flexed budget, we obtained 310, a contribution of $310. So this one was favorable. We verify if we have done our computations correctly. We know that, yes, we can do that. Why? Because we know that the sales volume variance is equal to sales quantity variance plus sales mix variance. So let us add the adverse variance of 31.67 and the favorable variance of 151.67. And I'm sure we are going to arrive at the sales volume variance of $120 favorable. Please do that. If you do not get that amount, then please send your comment in the comment section. I will attend to it and give you a feedback as soon as possible. Okay, let us now talk of, yes, you can read this one. It's good. It's actually essential for you as you prepare for this module. So you can as well read that part. Is essential. Let's talk of planning and operational variances so that we seal the deal and call it quits. Call it a goodbye for variances. No more problems, no more grandles, and so forth. So, beyond basic variances, planning versus operational variances. Let's look at the revised budget. This is a budget that is updated to reflect changes in underlying assumptions or conditions that were not anticipated when the original budget was prepared. So you have seen how we dealt with the revised budget in the last example. Calculations. This involves adjusting the original budgeted figures based on the new information. For example, sales. Revising sales volume based on new market research or competitor actions. Materials. Adjusting standard material prices due to unexpected market fluctuations. Labor. Incorporating the impact of a newly negotiated wage increase, overheads, reflecting changes in utility costs or other external factors. And I've indicated that you need to read around overhead variances. An example. If the original budget assumed a material price of $10 per kilo, but a major supplier announced a price increase of $12 per kilo, the revised budget would use the $12 per kilo figure for materials cost calculations. Factors for revising budgets. Fair adjustments. What justifies a revision? Good reasons to revise a budget include major external changes, for example, the economy, regulations, consumer tastes, and so forth. Significant internal changes, new products, processes, etc. And initial budget errors. All those should ignite a change or a revision to the budget. But what are the bad reasons to revise a budget? If we are having inefficient operations, please, we must not revise the budget, but correct those inefficiencies. Poor sales effort. If we are not selling, if we are not advertising them, do not reduce the sales target below. Why? Because you do not want to work. You do not want to get into the industry or into the market to sell your products. So that's not the reason for you to say, oh, the target is too high, please lower the sales targets. All right? Minor fluctuations and managerial laziness. Those shouldn't be the reasons to revise the budgets. In the examination, the examiner might say, oh, there was a discussion between the production manager, finance manager, and the procurement director where they were saying that, oh, the targets were too high, they should be, but, in most of the cases, the marketing manager would be found, would be reporting to work drunk. Sometimes he doesn't take those extra miles to market the products. He's always lazy, etc. And the only option or submission is given to the board is for them to reduce the standards down so that the sales revenues would be achievable. The targets should be achievable. All that rubbish should not be tolerated. Those are not reasons to revise the budget. Anyway, let's get ahead with the discussion. Let's get granular. Okay, now, two sides of the variance coin. Planning variance. These give us the difference, or these are the difference caused. The difference is caused by the original budget assumptions being wrong compared to a revised or more accurate benchmark. Sometimes people at the head office make errors. They give standards which are not communicating to the reality. That's planning variance. Okay? Yes, sometimes the standards which they set are not of this world. They are not speaking to what is happening, and that error is a planning variance. What about an operational variance? This is the difference caused by how well we performed against the revised, more realistic benchmark. This is normally related, or they are under the control of operational managers. Then total basic variance is equal to planning variance plus operational variance. For example, when we talk of the SVV, that's the total basic variance, which is given by the sales quantity variance plus sales mix variance. Are we together? Okay, we shall see. Um, all right. Um, okay. Okay. We can as well write, just forgive me for that. Normally wanted to say SVV is equal to the the market size variance, actually market size variance plus the market share variance. Okay. So, but I'm sure you have as well, you can as well appreciate that the SVV, the market size variance, is actually the standard, the sales quantity variance. Okay. Whereas this one is the sales mix variance. Okay, just look at this because you can see that planning variances are given in a way that we are looking at the original minus the revised. All right, so for example, for the SVV there, you can see that the market size variance is the original budgeted quantity minus the revised budgeted quantity multiplied by the standard contribution. So you can see, if we revisit our example here, that we were looking at the original budgeted quantity minus the revised, and we obtained the difference, which was this variance there, the 37.67 as our sales quantity variance. Then for the sales mix variance, we said revised budget minus the actual quantities, okay, which was the flexed. Remember, we flexed the actual. Okay, we flexed the actual. Okay, so we are still on the same page. We are still consistent. Please bear with us. So I was actually correct when I give you this. I was actually correct. All right. So as you can see, all these total variances have got their, or they can be dissected into planning and operating or operational variances. Okay, so for a material price variance, you can see that we have got the original standard cost minus the revised standard cost multiplied by actual quantity. One thing, for you to be able to understand this, you need to understand or to remember the original formula. The original formula, let me tidy up the screen. The original formula for MPV, we said this is standard cost minus actual cost. Yes, actual cost multiplied by the actual quantity. Okay. Okay, so once you know the original formula, you're not going to be lost. So the planning variances, know that we are talking of the original budget minus the revised budget. So in this case, since it's material price variance and the formula is standard cost minus actual cost multiplied by actual quantity. So we are looking at the original standard cost minus the revised standard cost multiplied by the AQ. AQ is that one. All right. Then we come to the other side and say revised standard cost minus the actual cost. This is called, it should be C. Sorry for that. Is what's going on. It's going to, this should be an AC, okay, not AQ. All right, multiply by AQ. All right, that's for the MPV. Then material usage. Now, usage, we are talking of quantities. So that's standard quantity minus actual quantity multiplied by standard cost or standard price. All right. So the standard cost is going to be outside. Why? Because in the formula it's also outside. Similarly, here, when we talked of the material price, we were saying this should be the standard cost minus actual cost multiplied by actual quantity. So the actual quantity is outside the bracket. So you can see that there is chronology and organization in the way these formulas are structured, isn't it? So for the MUV, the material usage, you come here and say the original standard quantity, because remember we're talking of standard quantity, all right, minus the revised standard quantity, okay, multiplied by the original standard cost. Okay, this is the same standard cost we are talking about. That's the original standard cost we're talking about. Then here, the revised, the operating variance also inherited the revised standard quantity minus the actual quantity. Remember, at the end, we have got the actual quantity there. So we talk of the actual quantity, that one, and multiply by the standard cost. Is that clear, ladies and gentlemen? All right. So this one, like I said, this is the standard, the sales quantity variance, and this one is the sales mix variance. So the quantity variance talks of the market size, whereas the market share talks of the standard, the sales mix variance. So this one was the sales quantity and that one sales mix. All right, so you follow the same pattern for the rest of the variances there. Is that clear? Let me rectify that before I forget. I'll end up forgetting correcting that anomaly. Let me correct it. We're talking of the actual cost, not actual quantity there. Okay, it happens. So all these variances are analyzed there. You need to read those notes and so forth. So everything has been tabled. Okay. Now let's talk of the dangers of manipulation. I'm going to do an example, a comprehensive question where we have got all these variances put together, and please watch out for that video so that you are rest assured that you have done the variances, you have covered everything you need on major variances that are going to be examined in your upcoming paper, the ACCA Performance Management. Okay, I'm going to solve the questions in Excel so that you are home and dry, you are safe. You need to be safe as we progress with these studies. Okay, we talked of the dangers of manipulation at the start of the lecture series where we talked of ethics, right? There should be some ethical considerations in the construction and revision of budgets. What's the temptation? revising budgets to make performance look better than it is. That's the key temptation to those who are charged with the revision of budgets. Sometimes we want to be good managers to the people, so we set targets or revise them, revise the budgets altogether with those targets which are easy to achieve. At the end of the day, we lose focus. We lose focus or strategic focus or direction, where we'll be now saving our own interests and leaving out those of the shareholder. So these are examples which show that our ethical grounding is not blameworthy. Okay, I mean, is not clean. All right, we need not to set targets which are too low, which might end up not motivating the workforce, or would be easier to achieve, and by the end of the day, we won't be meeting the corporate objectives. Sometimes managers end up blaming external factors for internal issues. All right. They, when they start to take that path, they end up, originating or crafting a case that is not there, just to ensure that their bid for budget revision becomes successful. In that situation, managers won't be, behaving ethically in the budget arena, right? This undermines accountability, reduces motivation, erodes control, and sometimes stakeholder trust. So what controls can be put in place to prevent budget manipulation? What do you think? What do you suggest? I want you to write on the comment section your suggestions to ensure that we are together in this area or in this study journey. All right, examples of controls that can be put in place are the first one is actually obvious, where we talk of segregation of duties. No one individual should participate in every stage of the budgeting process, from initiation to authorization and so forth. Okay, yes, a manager might come up or might submit the need for a revision, but the actual person to revise the budget should be different, right? Some people should come up with the idea, but others should then have to approve those changes. Not one individual should have unfettered powers to do everything from A to Z. All right, we might as well avoid this issue of manipulation through organizational hierarchies, okay, or approval hierarchies. Approval hierarchies, something like that. Hierarchy, the organizational hierarchy. It's almost the same as segregation of duties, but in this case, we need, somebody might come up with the idea, but they are not the people who are going to approve. When we are talking of segregation of duties, we are simply saying that the preparation of the budget, the accumulation, collection of data, all those things, the inputs, everything should not be done by one individual. But when it comes to the approval of a revision of the budget or the approval of the budget itself, such that it is now being published for use or to be implemented, that should follow some stringent hierarchy. Okay, where somebody might suggest, another might recommend, and then others have to approve. That control would ensure that revisions are going to be minimal. There is no manipulation, or the risk of manipulation is going to be limited or to be reduced. All right. Sometimes we need system-based budgeting. System-based budgeting tools, where we have budget systems or automated system like the Quantrix modeler, etc. There are a lot of budgetary systems or software which could be used to ensure that all changes, individuals are given certain access protocols. For example, somebody might be an initiator of a budget input. Others have got only viewer rights. They do not edit. Others have got approval rights, all those things. So system-based budgeting tools are encouraged. There is need for periodic reviews, okay, where we say that maybe we need to review our budget on a quarterly basis or on a biannual basis, right? To ensure that there should be some set times when we need to review those budgets, not every day. All right? There should be no times for budgetary reviews. Okay, if you have got other ways of controlling budget manipulation, please state them on the comment section to this video. All right, so key takeaways to this lecture as we try to wrap up things. Standard costing provides essential benchmarks for performance management. Flexed budgets are crucial for meaningful variance analysis. Controllability ensures fair performance evaluation. Okay, when a manager, has control of the processes, they are in a better position to be involved or to own the situation. And whatever assessment they are going to be subjected to, that will be seen as fair in their eyes, other than to be judged for things they do not have control upon. Advanced variances, mix, yield, planning, operational, offer deeper insights. Budget revisions must be justified and carefully controlled to prevent manipulation. Wow, I've been reminded of something. When we talked of planning and operational variances, let me just try to give you an example before we part short. Let's say you're a manager, okay? You're a manager of a branch that is situated in Ventura, okay? The head office is in Harare. All right, so they have set a material price variance of, say, $3 per unit. Okay, and you are also informed that inflation during the year has been 100%. All right, now the actual price, remember, this is the standard price of $3. But now you're also told that the actual price of the material was $5. Okay, so according to the MPV, all right, the MPV is going, the original MPV is going to say MPV is equal to 3 minus 5, okay, multiplied by whatever quantity. Maybe you bought 1000 kgs, so it was $3 per kg. So this time, if you multiply by the quantity, that's 1000 kgs, and your MPV is going to be that is $2,000. And this one, obviously, because the budget was $3 per kg of raw material, but this time you bought the actual price was $5 per kg, so you are having an adverse variance. So if you are judged on the performance of the MPV, if you are given a bonus based on the favorability of the MPV, then it means you are going to lose your bonus. But the question that comes is, was this fair? All right. So this means that the planning aspect, when the variance was set, it did not look into aspects like inflation. Okay, there was 100% inflation during the year, but the budget which was set at the start of the year was showing that the standard cost of the material per kg was $3. All right, so this is when we then have to look at planning variances, right? And we say that the planning variance talks of the original versus revised. Okay, the original versus revised. So the planning MPV, material price variance, should then talk of the original cost, the original standard cost minus the revised standard cost. What is the revised standard cost? The revised standard cost is not $5, which was the actual, but the standard cost which has been subjected to inflation. If inflation has risen by 100%, what is 100% of $3? 100% of $3 is actually $3, isn't it? So if it has risen by 100%, we are going to say this becomes $6. Are we together? The revised standard is now $6. So let us multiply by the standard, the actual quantity of 1000 units. So this time we can see that we are having a variance of $3,000. Is this favorable or adverse? Is this favorable or adverse? I want you to answer. Please pause the video. Okay, good. I'm happy you are following. This is adverse. Okay, so the adverse here is 3000 adverse. Why? Because the original budget was saying that the cost was going to be $3. However, when we revise, we taking inflation into perspective, we have discovered that the revised cost or the standard cost has risen to $6 per kg. Okay, so for planning purposes, we are having an adverse variance of $3,000. Okay, this has to be blamed on the head office. All right, the head office initially made an error when they did their budget. All right, now when we come to the operational variance, now the operation variance looks at the revised minus the actual. Okay, so the operational MPV. The operational MPV now talks of the revised, which is $6, minus the actual, which was $5, multiplied by $1,000, and this gives us a $1,000, which is favorable. Why is it favorable? The revised budget talks of a $6 standard cost. However, the actual price was $5. All right. So we used less than the revised budget, and we are getting a favorable variance. All right. So you can see then that if we add the 3,000 adverse plus the 1,000 favorable, we are going to come to $2,000 adverse, which was the original MPV, which we computed here. This is to solidify the statement that there was a statement where we said basic variance is equal to planning variance plus operational variance. So the MPV, which is the basic variance, is equal to the planning MPV. Okay, planning MPV plus the operational MPV. Remember, this is a V. Okay, I'm sure we are together now, isn't it? Good. Then coming back to the aspect of controllability, where we talk, we talk of fair performance evaluation. You can see that the manager would have lost the bonus owing to the misinterpretation of variances. Just by using the MPV, his bonus was could have been forfeited. However, as we dissected the variances into their operational and planning components, we discovered that the manager himself, using the operational variance, the operational MPV, should not be blamed. Why? Because he was having a favorable variance of $1,000. Is that clear, ladies and gentlemen? Good. That's something I wanted to point out before I call it quits, because I know deep down in my heart I was saying, oh, but there's something I didn't explain. There's something I didn't explain. So for those guys who thought that I was finishing, you need not to stop the video midway, because some of the essential information are going to be explained at the end of the video. You understand? Because remember, we are not following textbooks. We just have to be, using what, following our guides as we will be dishing out the information or the knowledge to you. Okay, so if you need further assistance, please, guys, do not hesitate to contact the ACCA tutor. And this is my number, +263 774 596 Okay, that's my number. It is compatible on WhatsApp. If you are tired of just paying people without results, please contact me. I will be ready to assist you. Until we meet each other in this video, we'll be looking at the typical exam question. Please continue to feel excited, and I repeat, very, very excited. For now, I'm signing out. Goodbye.